And now, before I turn the mic over to David Fain for the main program, I'm going to mention a few facts about David Fain, a second-generation Rotarian. So David moved to Seattle 4.5 years ago and joined Rotary his first week in town. He's an insurance specialist with MCM. So some fun facts about David. He paid his way through college as the ice cream man, and his favorite hobby is smoking fish. Please help me welcome David Fain to the podium.
Community service ambassador, chartered financial analyst, international dancer, and the very first woman to present Seattle 4's annual economic update. Are just a few of the ways that you can describe our keynote speaker, Michelle Mathieu. Michelle is a 25-year veteran of the investment industry and has what could be called a storied career. Michelle has led 3 different investment firms, co-managed 2 equity mutual funds, and served on a half-dozen nonprofit boards. Michelle started out in the banking industry, managing money for institutions and individuals. Early in her career, she was tapped to launch the new investment advisor and trust company at Perkins Coie. Many of us have friends and are members there, an international law firm. 9 years later, Michelle had grown the business to over $500 million in assets, and she was ready for another challenge. Michelle joined the Rainier Group in 2000, where she restructured the firm's investment division and drove 45% growth in new assets. She served as a principal and lead advisor until the company was sold 2 years ago. Michelle joined Fulcrum Capital as chief investment officer in January 2017. Fulcrum Capital, founded by our member Janet Welcher, is a Seattle-based comprehensive wealth management firm serving a select group of individuals, families, and nonprofits. Since Michelle joined the firm, Fulcrum has doubled in assets and is now the 7th-ranked emerging wealth manager in the country by growth and assets, according to RIA Channel. On that list, Fulcrum is number 1 as far as majority-owned and women-led. Michelle's accomplishments are even more remarkable when you realize how male-dominated the investment industry is. Fewer than 1 in 3 wealth advisors are female, and over half of advisory firms don't have a single woman on their team. Michelle holds the Chartered Financial Analyst and Chartered Alternative Investment Analyst designations. Nationally, just 16% of CFA charter holders are women. Michelle studied economics at Whitman College in Walla Walla and international politics in Freiburg, Germany. She lives service above self and is her firm's ambassador to the community. She's a member and past vice chair of Whitman College's Endowment Investment Committee, chairs the Diocese of Olympia Investment Fund, and is a board member for the King County Library Foundation. No surprise, she is also past president and board member of the CFA Society of Seattle. In all of her combined roles, she oversees more than $1 billion in assets for 70 private clients and 10 nonprofits. However, in her free time, she enjoys skiing, hiking, and reading. However, the hobby she is most passionate about is dancing. She currently is learning to tango with a professional dance partner for her upcoming competition at the Seattle Dances Gala for Plymouth Housing, which is on March 9th, just as President Cindy did last year. So after dancing for more than 16 years around the world while pursuing her professional career, she's quite pleased to be showcasing her talents in front of her hometown friends and family, and I know she would appreciate your vote in support on the Plymouth Housing website. So, as we say in Chicago, vote early and often. Michelle's comments on what's next for the world economy will be independent, refreshingly different, and in her words, unlike many of the canned comments we often hear this time of year. It is indeed a special honor to welcome Michelle Mathieu to the podium.
Thank you, David. Thank you all. Excuse me a minute. I'm going to get wired up here. There we go. Is that better? Yes. Yep. All right, good. Thank you. Thank you so much for having me here today. I'm thrilled to be here. And before we get started, I'm going to get this out of the way. Oops, not that. You can tell this is my favorite dress. It's in the picture there. All right, I'm going to have some forward-looking statements in this, so I do need to disclose some stuff about how these are disclosures. Go ahead and read those for a minute here. When I was growing up, I had no idea this is what I wanted to be. Girls didn't have role models like Sally Krawcheck or Janet Yellen back when I was young. In fact, back then, I wanted to be a computer scientist like my father. Or, wrong side, there we go, Mary Lou Retton. Yeah, I even had her haircut. And now I am a strategist. At Fulcrum, my role is to make the most of the financial future for our clients. And this should sound really familiar to those of you in this room. You are all business leaders, you're community leaders, you're strategists. Your role is to make the most of the financial future for yourselves, for our community, for this great big world that we live in. And now I'm going to share 3 things with you today. And since I only have a short period of time, I'm going to stick to my notes so we don't lose track. First, where are we today, and how do we handle these risks that we are facing? Second, my prediction for where we are headed. And third, what will be the growth drivers in the decades ahead? So where are we today, and how do we deal with all this risk? Here's the reality of what we are facing. Everyone is worried about trade wars and protectionism. In the US, earnings growth is skidding from 25% growth rate down to 5%. Corporate profits are under pressure from rising wages and inflation and tariffs. And thanks to the Federal Reserve, short-term interest rates have almost doubled in the past 18 months. Germany and Italy are sliding into a recession. China, the slowdown there is worse than expected. And we here at home are in the middle of the longest government shutdown in history. As a consequence, we are facing almost $1 trillion deficit because of the cost of tax hikes, tax cuts and spending hikes. Never before in modern US history have deficits been this high outside of a recession or a war. For those of you who brought your Tums or Rolaids, now would be a good time to take them out because all this is showing up in asset prices. What this chart shows is that across the board, every single asset class from stocks to bonds, even gold was down in 2018, except for cash and the safest treasury bonds. For the first time on record, going all the way back to 1972, not a single asset class returned more than 5% this past year. Not one. You don't have to read the numbers on the screen to see all the red. The average return across all asset classes last year was the 4th worst on record. 4th worst. More asset classes lost money in 2018 than in 2008. So no wonder you didn't want to open up those December statements, right? If all this makes you want to run and hide in a hole and just wait it out for a while, you're not alone. That 2% yield on the money market fund sounds pretty good right now, doesn't it? Well, maybe not so much. That would be wrong. In fact, hiding out in cash is not just counterproductive, it is dangerous. One of my favorite quotes from my childhood hero, Mary Lou Retton, is this. She said, "It may sound counterintuitive, but the comfort zone is a dangerous place to be." Here's the paradox. When you believe you're safe, we take more risk. And when we believe things are risky, we take less risk. And that sounds like it should make sense, right? Or does it? I'm going to take you back to 1975. Sam Peltzman was a Chicago economist. In 1975, he published a study called The Effects of Automobile Safety Regulation. Sounds awfully boring, but in fact, it was actually one of the most fascinating papers in the history of industrial organization. Peltzman studied the effects of safety devices in cars that were implemented in the 40s, 50s, and 60s. Things like padded dashboards and seatbelts, right? He wanted to see if all these things saved lives, and if they did, at what cost. What he found was that, in fact, no lives were saved. Within a few years, the number of deaths was back up to the same level as before. And in fact, if you included the additional pedestrian lives lost, the number of deaths were actually higher. Peltzman concluded that people were driving more quickly, more recklessly with all the safety devices. People had adapted. The safer they felt, the more risk they took, right? He said if you really wanted people to drive more safely, you take away all those safety devices and you install sharp spikes on the dashboard pointed directly at the driver. Naturally, in the decades that followed, there were hundreds of studies to see if the Peltzman effect was in fact true. And just a few years ago, NASCAR confirmed it. In NASCAR, whenever a new safety device is installed, the number of accidents and deaths goes up. Why is that? It's human nature. We adapt our behavior. And here's why this is counterproductive. Peltzman demonstrated when things feel safe, we get overconfident and we take more risk. We take too much risk. In fact, overconfidence was a large part of what led to the dot-com bust, right? At the other extreme is overreacting to risk. When faced with an immediate threat, our animal instincts tell us to just run for the hills. Playing it safe is just as big of an impediment to our financial success as overconfidence. And there are 3 reasons why there is danger in the comfort zone. First, if you sell and go to cash, you won't keep up with inflation, likely. Inflation of just 2% erodes half of your purchasing power in 30 years. Half. Second, obviously, if you're out of the market, you'll miss out on gains. Over the past 30 years, 7,500 trading days, you miss the 10 best, half of your wealth. You would have half of the wealth that you would have had if you had stayed invested the whole time. And third, you guys all know, you've heard that market timing doesn't pay. Well, the chance of being right is hard enough, but the chance of being right 2, 3, 4 times in succession is even more remote. How do you know when to get back in? If, on average, after a correction like the one we just had in December, it takes just 3.8 months to achieve the prior peak. 3.8 months. Okay, I can read your minds. It's a special trick I have. And I can see you're all wondering, if this is human nature, overconfidence, overreacting, how do I avoid these pitfalls? Well, here's the secret. Focus on the long term. Don't pay attention to the short term. By the way, did any of you see that article? I'm going off script here. In yesterday's New York Times, titled "Fire Your Male Broker." They cited, yeah. So they cited some research that there's been lots of research about how women investors outperform men. And the reason I think it is because women, it's not that we're smarter, we're just better able to handle these pitfalls, avoid these pitfalls of overconfidence and overreacting. We trade less often. It's actually probably also the same reason why index funds outperform most active managers. And in fact, I wonder what those statistics would look like if half of all fund managers were women. I'm really passionate about this. All right, so we're getting there. So, let me get back on track. Where am I here? Thank you. Oh, yeah, we were talking about staying focused on the long term. Stay focused. Thanks, you're helping me. Okay, this chart shows the Dow Jones Industrial Average going back to 1900. That is 6 generations. Over that time, on average, there was a recession and or a correction about once every 2 years. This chart clearly shows the benefits of staying in the game, staying invested. It pays to ride it out if you are a long-term investor. And the chart also shows that recessions are, in fact, very rare. That's the blue bars on the chart there. And they're very rare ever since the 70s, in fact, since we transitioned from more of a manufacturing to a services-based economy. Now, I was born in 1970, and in my lifetime, there have only been 5 recessions. That's about once a decade. And to be sure, the market goes down before or during recessions, but there are also time periods that the market goes down when it's not in a recession. In fact, there were 12 of those during my lifetime. The point here is we spend 3 times as much time worrying about whether we're in a recession than actually being in one, okay? So there's one thing that I want you to understand from our conversation today. That is this. In order to thrive long term, You must not focus on the short term. Now, I am getting to the reason why you're all here today. And I know you want to know what's next, where are we headed? And the question on top of everybody's mind right now is, when is the next recession? Thank you. This chart shows real GDP going quarter by quarter back 48 years. The blue dashed line at the far right, your right, the lower line, says 2.3%. That's the average growth rate during this expansion. We are on track for both the longest and the weakest expansion on record. Are any of you here chief financial officers, CFOs? No? A couple. Okay, I see a couple. Thank you. So in December, just a month ago, Duke University did a survey of CFOs, and 80% of them said they expect a recession by the end of 2020. Two-thirds of economists say the same thing. Now remember, almost nobody predicted the recessions in 2000 and 2007. To paraphrase a quote often misattributed to Mark Twain, what gets you into trouble is what you know for certain that just ain't so. And at Fulcrum Capital, when our investment team sits down and looks at the data, we do not see convincing evidence that a recession is right around the corner. A slowdown for sure, we do see that, but we don't think we're likely to get a traditional textbook recession in the US. And let me tell you why. There are three things that bring on recessions: a decline in consumer spending, a policy mistake, or an external shock. And we're going to take each of these in turn. First, the consumer, 70% of the economy. The consumer is in great shape, and as long as we're in great shape, it's extremely difficult to get a recession. The unemployment rate right now is at a 50-year low at 3.9%. Wages are rising 3.2%. That's a full percentage point ahead of inflation. This, combined with tax cuts and lower oil prices, sets up a strong backdrop for the biggest part of the economy, consumer spending. And this chart shows consumer confidence is very strong. It's elevated at high levels. Now, at the end of December, you can see the chart at the far right is starting to hook down. Consumer confidence did start to tick lower on the heels of the sell-off in the stock market in December, but it's still at very elevated signals. One reason that consumer confidence is so high is because we're feeling very good about our net worth. Net worth has grown 54% since the last peak in 2007. It's at $106 trillion in the US. This bottom chart shows that our debt burden is lower than any time on record, going back to the early 1980s. That's thanks to low interest rates, rising incomes, rising asset and home prices. This sets up the scenario that our debt service ratio is now less than 10% of income. That's the cost of our debt service, our interest expense, as a percentage of disposable income, less than 10%. That's 25% lower than where it was at the peak in 2007. So it's true some short-term indicators like consumer confidence, as we just saw, are flashing warning signals. But it is really important that we put this into context. When you zoom out and look at it in the big picture over the long term, it's really hard to see a consumer-led recession under these conditions. So the consumer's okay. What about policy risk? To be sure, heading into 2019, we are running the risk that contractionary policies are setting us up for a recession. We've got rising interest rates, trade tensions, protectionism, a government shutdown. All this is layered on a highly levered financial system. And I'd say policy risk is higher than at any time in recent memory. Right now, the Fed is raising interest rates at the same time they are unwinding their massive balance sheet. Both of these things constrain growth. Indeed, corporate earnings are showing signs of slowing and weakening. Here in the US, I mentioned, we're slowing from 25% plus rate, and we are not alone. This is happening globally. Take a look at the green line for the US and follow it back toward the middle of the chart, a couple years, where it crosses the purple line. We experienced a slowdown in earnings in 2015 and 2016. In fact, here in the US, we had an earnings recession. Corporate profits were down. We didn't have a textbook recession in GDP, but corporate profits were down. So were they in Europe and the emerging markets. Back then, central banks were piling on stimulus. They were buying back bonds. They were lowering interest rates. They were enacting fiscal spending bills and spending hikes. And this helped fill the pothole, so we averted a recession. Now heading into 2019, we're seeing another slowdown. And in fact, we'll probably see corporate earnings maybe even decline 1 or 2 quarters this year. So everyone is worried, and one wrong move and we might be plunged into a recession. But if you look ahead 6 or 12 months, perhaps the policy risk is actually to the upside, not the downside like everyone is fearing. We believe that this is the case. First, government forecasts itself says that the stimulus already announced will amount to 2.1% of GDP this year and 1.4% in 2020. Second, interest rates. Now we're at 2.5% in that range in short-term rates, and that gives some ammunition to lower rates further to further stimulate the economy when we need it. The US has this in our back pocket. And third, no matter what you think about our administration, do not underestimate their willpower to do whatever it takes to get reelected in 2020. And top of that list, we believe, is avoiding a recession, or at least postponing it. To postpone a recession, they are likely to enact policies that will stimulate consumer spending and confidence and stimulate business investments. Some arrows in their quiver include solving the trade dispute, indexing capital gains to inflation, increasing spending, perhaps an infrastructure bill. So here's the point. Near term, yes, there are plenty of reasons to be worried about policy risk. But looking out longer term, the policy wind should be in our sails, and there's plenty of room for policymakers to kick the can further down the road, which brings us to the third cause for a recession, an external shock. We've had several of these over the past decade. For example, the Greek banking crisis in 2011 and 13, the Chinese devaluation of their currency in 2015, Britain voting to exit the Eurozone in 2016. Our economy has been able to withstand each of these shocks. Flexibility and resilience in the economy and the capital markets are key for, and continue to be key for us to absorb these inevitable external shocks. And that resilience depends in a large part in our seemingly inexhaustible ability and willingness to issue more debt. More debt, more debt. Indeed, around the world, companies and governments are spending money today that they're promising to pay back later. This chart shows global GDP has exploded tenfold over the past 30 years to $109 trillion. Most of that growth has been outside the US. This poses a risk on many fronts, to be sure, but in the interest of time, I'll focus on just one, and that is, as rates rise, the cost of servicing all of this debt could be crippling. Almost half of government debt outstanding is maturing in the next 3 years, and that carries an average interest rate of 1.83% for government debt. They're needing to issue new debt to retire the old debt and service existing debt and fill that $1 trillion deficit I mentioned earlier at rates of 2.5%, 3% or more. And this is the concern. The cost of this debt at this pace, the government projects it will be spending more on interest expense than on Medicaid by 2020, more on interest expense than defense by 2023. Risks are also building in private credit, bank loans, Italy, China. And when you have a highly leveraged financial system like this, exogenous threats like a currency crisis or a country defaulting on their debt pose very serious risks. Okay, wait a minute. I think I see all of you have stopped breathing, and let's take a deep breath and step back, because this is very important. Here's the good news. While the level of debt is enormous, so is our ability to repay it. Interest rates are still low. Like we saw with households, the corporate debt coverage ratio shown here is actually well above its 48-year average, and this chart shows earnings for US corporations are 5.8 times interest costs. It's even above the pre-crisis level. Now here's the point. Our debt is enormous, but our economy is resilient, our economy is diversified. Like in 2012, 15, 16, we have plenty of room to absorb external shocks. They are inevitable. The risk is not that we'll get a shock. We are going to get them. The risk is that we overreact. So I've covered where we are. I've covered what lies ahead. And now I want to give you some good old-fashioned Seattle Rotary style inspiration. How do we grow in the next decade? What are going to be those drivers? The answer, I believe, can be found by studying major trends in productivity. Productivity is the measure of output per worker. Looking back, we can identify some major themes here. In the 70s, the addition of women to the workforce helped drive 3.2% productivity growth. That momentum continued into the 80s when the advent of the personal computer drove increased output. In the 90s, it was the internet. In 2000s, it was e-commerce. But wait, look at that. 2007, it stalled out. And since then, our productivity growth has been cut in half. What gives? What happened in 2007? The iPhone was invented. So perhaps social media has been a drain on productivity. Not too far-fetched. But by now I'm an optimist, okay? So I think there's something else really important going on here. Remember, productivity growth means doing more with less. And so does the rise of the sharing economy. We're using existing resources that were underutilized before. Remember when you thought it was totally ridiculous to enter your credit card number online? Who would do that? Or who in their right mind would get into a stranger's car or sleep in a stranger's bed? It took time for us. Okay, well, maybe not that one. It took time for us to grow accustomed to trusting technology and to trusting faceless strangers. But now the world's largest taxi company, Uber, owns no taxis. The largest hotel company, Airbnb, owns no beds. The largest media company, Facebook, owns no content. The largest retailer, Amazon, until recently owned no inventory. That these companies don't actually own anything is their virtue, not their flaw. The sharing economy is totally revolutionary. It's the reason why traditional measures of productivity don't work. It started with consumers, and the next phase, I believe, will continue with the sharing enterprise. We have companies coming to market now like Smartsheet, Asana, WeWork, and we're still in the early stages of this. Many of the greatest advantages that we enjoy today were totally ridiculous and uncomfortable and far-fetched when they were first introduced. In the late 90s, you could order groceries online and have it delivered to your door by web van. It was not a bad idea, it was just early. The technology wasn't ready, consumers weren't ready. And of course, web van failed spectacularly. And now you can have prime delivery in hours, all thanks to the sharing economy. In the early 1900s, the only purpose elevator attendants served was to help you feel comfortable riding in a self-driving elevator car. And now we have self-driving planes, trains, and automobiles. Talk about getting outside your comfort zone. Image. Oh, that's okay. So we had a couple more slides, but it looks like they're not loading. That's fine, we can look at that one. We'll go ahead and look at, that's great. So I recently had a chance to meet Janet Yellen. It was awesome. I was there there we are. That's with my business partner and co-founder of Fulcrum Capital, Darcy Johnson. We got to meet Janet Yellen, and we asked her about all this soggy productivity growth. What's up with this? And she explained to us that slow productivity growth and an aging population mean these things increase savings and weaken investing. And this in turn means that the normal level of interest rates, both long-term and short-term interest rates, was likely to stay lower for longer. Low interest rates, tax cuts, and increased government spending, she said, create an incentive to invest, an incentive to take risks. And it is this incentive to invest and take risks that is going to keep driving and bolstering growth for quite some time. Beyond the sharing enterprise, we believe the next big thing will be just like every other big thing. It'll be something that makes us very uncomfortable today. We can't begin to fathom how augmented reality or virtual reality will become viable business models or help us be more productive, but it'll happen. It might take 10 years or longer, and there will be some web vans along the way, but we can be pretty sure somebody will figure it out. In summary, if you believe that a recession is not just around the corner, and if it is, that we can ride it out, if you recognize the dangers of overconfidence, if you don't overreact to near-term risks, if you do these things, then you can focus on the long term. You can get out of your comfort zone, and you can not only survive, but thrive. So there are also alternatives if you want, so I'll leave you with this thought in case that doesn't work for you. There's always an alternative. And I'd love to take some questions from the floor. Thank you. We have time for some questions, so bring them on. We have 5 minutes. Okay. There we go.
David Brenner, do you have any opinion about job replacement by artificial intelligence and that potential for an impact on market shock?
Thank you. Yes, I do. I saw a billboard the other day. I think it was a financial services firm that said, well, when I'm retired, at least a robot isn't going to take my job. So, yes, I do think that there is disruption that's created by replacement of workers by technology. This is not new. It's happened before. And there are also side effects that actually create more roles for workers. We are working smarter and harder and differently than in the past. I think also that this is a great solution. We have such low unemployment rate right now that greater productivity and efficiency that can be provided through alternative artificial intelligence and robotics creates opportunities for the existing workforce to be more fulfilled and more productive.
And we have a question from Dave Graff.
Yes, thank you for the presentation today. One storm cloud long-term that maybe is even more short-term, I would appreciate your thoughts, is of the potential shock value is global warming and its impact on the world economy as well as the world industries. Mm-hmm.
Yeah, climate risk is a real and present danger. The pending bankruptcy of PG&E is the most tangible and recent example of that. And it's very important. It is existential for us to address this. No matter which side of the argument you are on, it's irrefutable that it is having an effect. When you see something like what's going on in California, it is very important to many of our clients. And I'll step back and talk about how we invest, because if you have these values, how you invest your assets, and as well as how you spend your time and energy, should be aligned, we believe. And knowing what you own is a great way to align those two values and your investments. Thank you.
Question from Jan Levy.
I'm sorry. Oh.
Hi. Just very quickly, you gave a nice regional, national and international outlook, but I'm curious to know what your sort of thoughts are about our own Puget Sound regional economy and where we're headed here.
Thank you. Yes, the local economy is so robust, and we see great investment in resources. Companies are moving here. People are moving here. We're running out of time, so I'm a little distracted, but I'm very optimistic about the local economy. I do think prices on commercial real estate and residential real estate will plateau here while we absorb some of this new supply, but the long-term outlook is very positive. Thank you so much.